So what we've been doing is talking about, we talked about how to calculate the free cash flow to the firm, to equity, but we've been talking about exceptions and what type of adjustments you might want to make. Another of those adjustments is, what if your company is experiencing big problems, but those problems are expected to pass? Okay, so what if you have negative or abnormally low earnings? What should be done? Well, why are the earnings negative or abnormally low? Let's try and find out. One, is it just some temporary problems, just like that one-time event which we mentioned before, a fire, a strike, an earthquake, something like that? If it's a temporary problem, you might want to normalize the earnings, take an average, or remove the effect totally. If it's cyclical, okay, if it's something which is a problem just because of an economic downturn and it's expected to improve, again, you might want to normalize the earnings and remove at least part of that effect. And how do you normalize? Here's something. If the firm's size has not changed significantly over time, then perhaps use some type of average over the previous years to put into this year's number and out into the future. But if the firm's size has been changing dramatically, or if its return on equity and so on has been changing, then you might want to use the return on equity number that it had from before. And, you know, if its assets or its equity has increased significantly, multiply that number by the ROE or the ROC to obtain a measure for the coming years, to use for the coming years in your normalization. What else could be going on? Well, it might be due to where in its life cycle the company is. Okay, so a very young firm, or a firm which is right now undergoing a reorganization, or just correcting some big problems, and as a result, it's having to spend a lot of money right now, but it will make it better for the future. Okay, so in these cases, you may also want to make some adjustments. Leverage problems, the firm is operating well, but it simply has too much debt, so its interest payments are very high. Or does the firm have long-term problems? Okay, so its cost of production is very high, or it's not able to increase its prices or whatever. So long-term operating problems, this may be treated very differently from some of these others. For example, a young firm which is losing money right now, you probably would estimate out until it becomes a profitable and stable company, and then estimate from there. But a firm with long-term operating problems, well, it's probably expected to continue unless there's a takeover or something like that which occurs, in which case, can it be fixed, would probably be the thing you need to look at. If it's having leverage problems, well, what can it do does it get a lot of investment from its investors, from its equity holders, paying off some of that expensive debts? And then what would the condition of the company be at that point to look forward and use in your estimates? Okay, so you basically can look at those problems and figure it out. Another thing you need to decide on, the tax rate that you need to pay. What should it be? Should it be an average rate? Should it be the marginal rate? Should it be, effective rate? So effective tax rate is basically how much tax you paid over taxable income. Or over EBIT. Marginal tax rate is the one that the typical investor is paying at the margin on its last money that it's earning. Weighted average marginal tax rate takes into account that different people at different levels have different marginal rates, and kind of tries to estimate what is the average across different groups of this. None of the above, any of the above. Typically, you would probably use something like the effective rate, what's actually being paid. Okay. And you may be able to get numbers for these. Some accounting, auditing companies give you these, or in Turkey, you might look up what is the rate, and it typically will be increasing from country to country. So take a look at these. Yes. So the choice is, should I use the effective or the marginal in my projections? Looking out into the future, the effective might typically be lower than the marginal tax rate, but the marginal might be the one applicable if things are going to go well and the company is going to continue to increase its profits and its sales. So safer to use the marginal tax rate. The effective tax rate might also have a lot of discounts, which they have right now, which may not last out into the future. Now, this is more interesting. What if your company is actually losing money? Okay. What is the tax rate to use for it? Again, I'm not going to go into details of this, but sometimes companies that have gone bankrupt and will not be able to make it out of bankruptcy may still be valuable, especially if the purchasing company can use their tax protection. Okay, because if you have accumulated losses of $1 billion from the past, and if I buy your company and I can take that 1 billion accumulated loss and deduct it from my taxable income, and if I'm paying, 30% taxes, that means that 1 billion accumulated loss actually means that I pay 300 million less in taxes. So it can be pretty valuable. You might want to take a look at that. Okay, then bringing us to net capex. How do we calculate these things? What do we want to be looking out for? Okay, so what is net capex? It represents difference between capital expenditures and depreciation. Remember, depreciation expense is a non-cash expense. So it's available to the firms to be able to make at least part of the investments that they have to make in order to allow the company to grow. Cash inflow that pays for some or lots of the account. Yes. Net capex will be a function of how fast the firm is growing or expecting to grow. Yes. Firms which are not growing, zero growth. For example, these companies might actually have zero net capex. So they're simply replacing the machines that are wearing out, and depreciation expense might be enough to meet all of that expense. But if your company is growing 10%, 20%, 50% each year, then the amount of new investment that it has to make definitely will be higher. Okay, so high growth firms will have much higher net capex compared to low growth firms. So yes, assumptions about how much net capex your company has to depend on how much you expect it to grow. Okay, we will see, especially in the next presentations, more about this relationship between the growth rate and the amount of new investment that is necessary to support that growth. So what kind of things should it include? Okay, like the corrections we made before, CapEx, if you properly account for R&D as, creating an asset, then R&D should also be considered to be part of your CapEx. Acquisitions of other firms. If your company is growing, not organically, but by purchasing other companies, then again, you may want to take this into account. Yes, in that case, adjusted net capex will be net capex plus current year's R&D expenses minus amortization of the research assets. Okay, so we're adding that additional investment into the R&D assets as another capex. Similarly, if you're buying other companies, the money that you spent to buy the other companies minus the depreciation of those purchases should also be included in capex. Be careful. So a caveat or two caveats. Most firms do not do acquisitions every year. Some companies, yes, they buy companies every year, but some companies might buy a big company once every 3 years or 5 years. In that case, you might want to take that amount and spread it over the amount of time between purchases to give you a more smooth look into what the cash flows are like. So normalized measure of acquisitions. Where do you find information about acquisitions? Look into your financial statements, other investment activities, and in the footnotes to the financial statements, you would probably find information about these. So Cisco, a company which has been growing by buying companies. So notice just in 1 year, 1999, they bought 1, 2, 3, 4, 5, 6, 7, 8, 9 companies. The method of acquisition, pooling versus purchase accounting, is slightly different. In some accounting courses, you might find out more about these. But pooling is when you combine the financial statements as if they were always one and the same, whereas purchase accounting is just like you go out and buy it and add it to your company from that point on. Pooling acquisitions funded with stock. Okay, so these apparently also, the price paid was in equity, so in new shares. And you need to go in and find how much was actually paid. So they had about 2.5 billion of acquisitions in 1999. And Cisco's net capex actually was only about 98 million in 1999. So if you think about it, a company which only has net capex of this much, so very low, you might say, oh, this company can't grow. The problem is that Cisco is not necessarily growing by making investments in its existing assets. It's growing by buying other companies. So this R&D and acquisitions, when you add those in, notice how much bigger the actual net capex is. So Cisco is growing not by investing in fixed assets and in working capital. It's growing by spending money on research and development and spending money to purchase other companies. And look at the difference, 98 million or 0.1 billion versus 3.7 billion, okay? So a huge, huge difference. And Cisco is growing a lot, okay? It's just not growing from this CapEx investment. In addition to this, long-term net CapEx, you also need to invest in working capital, right? So working capital accounting measures it as the difference between current assets, CA, like inventory, cash, accounts receivable, and current liabilities, accounts payable, notes payable, short-term debt, and so on. But we tend to use non-cash working capital. Why? Because cash, again, if it's excess cash being held by the company, then separate it out, value it at its current value, and then value the rest of the company with its non-cash working capital. And then later, we will add these together to obtain the total value of the company. So any investment in this measure of working capital ties up cash. Yes, it needs to be made. Forecasting future growth, be careful, okay? Some companies have strange working capital numbers. So we will see some examples of those as well. But again, typically a company that is growing has to invest in fixed assets, long-term assets, and in short-term assets to allow it to grow. It needs to be taken into account. So changes in non-cash working capital from year to year tend to be volatile. Okay, so there may be big changes from year to year. So in that case, you may actually want to use some type of kind of long-term fixed amount, maybe as a percentage of the revenues that is being held in working capital. More interestingly, some companies may have negative non-cash working capital. What does negative non-cash working capital mean? Well, it means as the company is growing, if this can continue, then this is a huge benefit to the company that grows. Why? Its current liabilities is increasing at such a nice speed that it is making all of the investments in current assets, plus it has something left over. Okay, certain types of companies may be able to do this. Walmart, interestingly, has something like this. Why? Because they buy from their suppliers. They don't pay cash, they pay on credit, and they sell the assets, the inventory, so quickly that sometimes they collect the money before they have to pay their suppliers. So this might be an example of negative working capital. And this may be able to persist, okay? But for most companies, this is not something that can continue indefinitely. Okay, Amazon, Cisco, and Motorola, 3 examples of companies which had negative non-cash working capital. Sorry, Motorola was positive, but Amazon and Cisco. So Amazon minus 419 million, Cisco minus 404. And as a percentage of revenues for Amazon, this was about 25% of their revenues. This is, again, before Amazon became as big as it is now. So, now it probably would be a much smaller percentage. Cisco, this is only about 3% of their revenue. So yes, it is a negative working capital amount, but it's not a big proportion of its revenues. And the year before, Amazon had still been negative, and Cisco was also negative. Motorola has gone from negative to positive working capital, so big change from year to year. Over the last 3 years, the average has been about 15% for Amazon, 3% for Cisco, and positive 9% about for Motorola. And the industry is around 8.71 for retailers. Amazon is an online retailer, so it may be a little different. For Cisco, it's minus 2.71. So in the software and computer industry, yes, this might be possible. They don't hold a lot of inventory. And for Motorola, it is plus 7%. So this is big fluctuations. So in the valuation that is done, what should we be using is the question. Well, Damodaran suggests that, well, if he was doing a valuation for these for Cisco, because the industry has been consistently negative and so on, still you might not want to leave it negative, but you might be able to say, well, as a percentage of revenues, working capital might be 0, okay? Because again, they don't hold a lot of inventory to be able to meet their growth targets. But for a company like Amazon, this probably is not something that can persist indefinitely. So for them, they're not going to be as high as the industry, but they're probably not going to be able to continue with negative working capital. So as an assumption, 3% of revenue was used for the long term. And for Motorola, they changed things around a little bit. So they basically said, well, even though it fluctuates a lot from year to year, let's just assume that the current, 8.23 may be usable for the future. So let's stick with that 8.23 is what they did. So now we come to free cash flow to the firm we've been talking about and the adjustments we might want to make to it. But here, let's talk a little bit about the free cash flow to equity as opposed to the firm. So why not use dividends as cash flows to equity? Well, in your introductory class, you did exactly that. You used dividends to value the stock of the company. And you're right, it is an actual cash flow going into the hands of the stockholders. Okay, so in that case, yes, it may make sense. And in addition to dividends, sometimes we say, well, we might want to add some things like stock buybacks, which some people might say, oh, I'm not even going to use that. But what happens when a firm which could pay out much more in dividends chooses only to pay out a small portion of its free cash flow in the form of dividends? When you do a valuation using that low amount, the actual dividends, you may actually end up with a company with that DCF of its dividends actually is undervaluing by a huge amount. So the actual free cash flow that we're trying to calculate, you might call it potential dividends. So actual dividends, when they're significantly less than the potential dividends that we're trying to calculate, what could be paid out in the form of dividends after still reinvesting for growth, then we will, be understating the actual value of the company if we only use dividends. So that's an argument for using the potential dividends as measured by free cash flow to equity. Some analysts assume earnings of a firm, its potential dividends. Not true. You can't pay out all of your earnings and continue to grow. Okay. So taking these into account, for potential dividends, free cash flow to equity is what we need to use. And furthermore, part of the investment in working capital and in net capex will be coming from debt. Okay, so that also needs to be taken into account. So we end up with this. To estimate the free cash flow to equity, what are we going to be using? So here, cash flows to equity for a levered firm, for a company that is using debt, we start out with net income, which is after taxes, right? So net income minus net capex minus change in non-cash working capital, but also taking into account, are we issuing new debt? Actually, I would put a plus sign here and reverse these. So net debt issues minus principal repayments. This is how much addition to debt have we made this period, okay? Because that actually is a cash inflow. If my debt has increased by 200 million, that means that 200 million has been used for capex and working capital needs of the company. And only if more than that was needed is it going to come out of the net income, what belongs to the equity holders. So free cash flow to equity is net income, deducting for net capex, deducting for working capital, and adding back in how much of that was financed by creditors. So here, preferred shares, if the company has preferred shares, you would also deduct preferred dividends. But if there are none, we would leave it as is. So here, this is a simplified formula that can be used if the debt ratio of the company, so debt to total capital of the ratio, how much of financing is coming from debt versus how much of it is coming from debt plus equity. So if this delta, small delta, is the percentage of the financing that is coming from debt, then you can simplify the previous formula and say net income minus net capex multiplied by 1 minus delta. So 1 minus delta is how much of it will come from equity, because the delta portion will be coming, the delta percentage will be coming from debt. So 1 minus delta of the net capex minus 1 minus delta of the working capital gives us a free cash flow to equity. So again, this formula can be used, this simplified formula can be used if the debt ratio of the company is fixed, is staying constant. And as an example, let's use this to calculate the free cash flow equity for Disney company. Disney had a net income of 1.5 billion Its capital spending was 1.7 billion. Depreciation was about 1.1 billion. And the non-cash working capital had gone up by about 477 million in the last year. Its debt ratio was just under 24%. So estimating the free cash flow for 1997 of Disney, start with net income, 1.5, minus net capex. So the difference between this and this. So that's about what, 600 million multiplied by 1 minus the debt ratio. Okay, so if this is 24%, about 76%. 76% of 600, about 465 of the net capex needs to come out of net income. And similarly, for working capital, if we need to invest 477 million in working capital, 1 minus the debt ratio of that, or 363 million of it, will come out of net income. So the free cash flow to equity is equal to 1.5 billion minus 465 minus 363. So it comes out to be 704 million free cash flow to equity for our company. The actual dividends paid by Disney were about half of that amount. Okay, so this is an example of a company that is not paying out as much as it could in dividends. Which one should you use in your valuation? Free cash flow to equity would be the correct amount to use. Well, what if, as the debt ratio goes up, if my free cash flow to equity is automatically going up? So look, if the debt ratio were 0%, we'd have this. If it's 80%, we'd have this. So as the debt ratio goes up, free cash flow to equity also goes up. Wow, that's wonderful. So if we were valuing the equity, it seems as if we could, get a real good deal, just increase the debt and free cash flow to equity also goes up. Wow. So does this mean that the value of equity, more debt, immediately value of equity goes up? Be careful. Because yes, the free cash flow to equity is going up as you use more and more debt, but keep in mind that more financial leverage, more debt also pushes up on the discount rate because it makes, remember the beta, it increases the beta of the company, the levered beta, and as a result, the beta goes up and the discount rate also goes up directly with this. So whether the value of the company, of the equity of the company actually goes up or down depends on which of these dominate. And that brings us to our last slide. So in a DCF model, increasing debt to equity ratio will generally increase the expected free cash flow to equity, yes, over future time periods, and also the cost of equity applied in discounting these cash flows. So cash flow goes up, but the discount rate also goes up. Which of the following statements relating leverage to value would you subscribe to? Would you argue is true? Increasing leverage increases value because cash flow effects dominate discount rate effects, or increasing leverage will decrease value because risk effect will be greater than the cash flow effects. Or C, increasing leverage will not affect value because risk effect will exactly offset the cash flow effect. Or D, any of the above, depending on what company you are looking at and where it is in terms of current leverage. So which do you think is true? Well, this actually goes back to, if you remember your finance classes that you had before this, do you remember the Miller and Modigliani theorems? It depends on which of those you believe in. If you believe, M&M is, Miller Modigliani holds everywhere, that debt structure and value of equity, don't change, it exactly offsets, you might say, that C holds. Or if you argue that there's an optimal debt level, optimal debt ratio, that the value of equity rises up to that point and then falls beyond it, then you might say, well, all of these hold depending on where you are. At very low debt levels, probably increasing debt will mean that the value of equity is going up to a certain point where it remains constant, and then it starts coming down when you start to have excessive debt. So that's where we are. So that concludes our look at the free cash flows to the firm. I hope you've enjoyed our online class, and I will be uploading this to the net pretty soon. I hope you enjoyed. If you have questions, please get in touch with me. So I'll be seeing you. Goodbye.